All right. Hey, good morning, everyone. It is great to be back with everybody live. Thank you for taking the time to dial in. I'll just start jumping right into it here, and we'll try to make um, a little bit of sense out of the chaos that we've seen. Really want to thank Jeff and Phil and Andrea for holding the fort down. Jeff's done a great job on his reviews the last couple of weeks, and I think the best way to summarize the all of the month of July, right, is we went everywhere and absolutely nowhere. So this is the first trading day of July, and this is where we are. So literally, we've just consolidated for a month. And so we've got this huge tension between one major trading principle that we really like, right, which is consolidation favors continuation, which would be a bearish interpretation. And then you've also got the underpinning formations and some of the technical action that's showing maybe we've actually bottomed some of these markets and we need to work higher. So let's just kind of walk through the universe here on the fundamental side of things and see what catalysts could be out there that are ranging back and forth. So you've got the markets under intense pressure from geopolitics, inflation, and everything just seems to be moving in boats, right? Like if you pull up a quote screen on any given day and you look at equities and bonds and commodities, you're either going to see all green or all red. There's very few days where you're actually seeing the markets um, um, diverge from each other and trade just on their own fundamentals. Everything's just getting pushed in a giant sea. And I think the only way to really think about that is to just know that that's temporary. Um, if you go back and do the analysis and try to figure out how often that happens, it's not very often. The correlation that these things have to one another just isn't very strong. So you have to assume and you have to plan that at some point in time, we will, with 100% certainty, come back and trade our balance sheets because everything in our business fluctuates around our supply and demand. And so I think that is why you see all of this volatility, all these extreme swings, and yet we've gone absolutely nowhere because the market is simply consolidating and it is trading a range of balance sheets here until harvest in order to figure out where it's going. So I think that's the best way to summarize all the chaos. And I think it's really, really important. I was just telling Jeff before we started this, I've been out for a week, and that was so refreshing because I wasn't reading all of the normal reports that I've been reading, and so being away from it gives you a lot more comfort when you make it simple. So if we just look at our charts and we just look at our carryouts, that should be enough for us. We don't need to get worried and sucked into the news flow of what Pelosi's doing in Taiwan or what's happening everywhere else. And I have the tendency, Jeff has the tendency, we all have the tendency to get sucked into that because we want information and we look for, why did this happen? Why did soybeans rally $2 and then in the next day give it all back, right? Why did it do that? Well, there's no reason. Nothing changed from Friday to Monday. Yeah, we had weather forecasts and things like that, but really nothing shifted. Um, it's just noise. And so what we have to do as traders is figure out where we want to be in relation to that noise. So let's jump in and talk about corn, okay? Um, where are we at? Well, we want to be long cash. And why do we want to be long cash, in our opinion, at this time in August, coming into crop reports, coming into harvest, coming into a great unknown? I think that the reason we want to be long corn is because this balance sheet is too tight. Okay. We're dealing with a range of yield estimates somewhere between 175, 170, and 178. I think the top end, I really don't think that the 180 number is being taken seriously by anybody. And so it really all depends on what our final yield is and how much our in demand number really is. And if you look at the demand numbers, um, we're strong. We don't have a big reason to think that we're going to come off of demand very much moving forward. So here's our use total. You know, if we just hold where the USDA is and we drop our yield to 171, we're way too tight. So the USDA next week is probably going to hold their magic 10% number. They might move demand a little bit, they might move yield a little bit, but I don't think they're going to come down to this. They're going to make us wait till harvest. So there's a lot of analysts that are out there saying, well, if the USDA doesn't come down on yield, then we may work ourselves lower. It could happen, but I really don't think so. So let's talk about how you manage this, okay? You got three choices. You can hold your cash, you can sell your cash and look to buy calls, or you can buy puts. Those are your three options that you can use. If you buy puts, you have to recognize that a $6 put is trading. Let me get this up on the on my other screen here, so I can look at that real quick. A $6 December corn put is trading for 43 cents, which gives you a floor of 557, okay? So if you pay 43 cents for a December put, you're going to have a true floor of 557. Now, that doesn't look very attractive to me when you look at this chart, because you've got all of this natural chart resistance right back in here. You're going to get very little bang for your buck if you come out and you spend 43 cents and buy a $6 put. So let's take put ownership just off the table, okay? Because the only way you can really make that work is to sell calls, and in order to finance it. And I don't really want to be short a whole bunch of calls on everybody's full crop production unless we're really comfortable with the margin and we're really comfortable owning futures, because if that 171 comes out, then corn could really rocket higher. If this low is, this could in fact be the low, so you could rocket this thing up out of here and so you don't want to sell a whole bunch of calls. So that really leaves us with two options, right? Which is hold our cash and be patient and do nothing, or sell your cash and look to re-own it with calls. Well, calls aren't any more attractive than puts, because that puts a $6 call is worth 40 cents. So that puts you re-owned back at 640. So what we've really got to do is wait for the volatility to kind of contract. You've got to wait for the market to give you an opportunity to do something to meaningfully hedge. And we've talked about this for several weeks, as long as we're holding above this range between 77 and down into here, I see no reason to get overly nervous about corn. I think that the basis is strong. You know, you drive around the countryside, the crop doesn't look that good. I think the yield estimates are so wild and so variant. You just have to assume that the crop is getting smaller, not bigger. I think that the overall demand structure and the overall need for food is higher than it has been, and so I think you've got to market yourself in a way that gives you the most upside. And I think that for today, the best upside is just sitting, and maybe even selling puts if it's in order to collect a little bit of premium. I know that goes against what you read on Twitter, and I know that goes against what you would read from a lot of different analysts. But look, analysts are subject to their clients too. So if you get 5 phone calls from clients and they're all freaking out because the price of corn has been down, you know, that's going to flow through into your analysis too, and you're going to start saying, hey, I'm going to publish more bearish reports because I want to please my client base. I don't want that angry phone call of saying, hey, corn's down and you're saying it might go up. Well, a good marketer doesn't care what anybody else thinks. We only care about what the charts are telling us, and we only care about what we know to be true. And what we know with 100% certainty is that at the end of the day, this number wins, regardless of what anybody else says. And you know, the odds that this thing breaks way lower and goes and takes out $5 just off of the setup that we have here, I think is remote. And I don't think anything's changed from the early July analysis that we've done over the last several weeks. I don't think there's anything out there that would change that. Now let's talk about soybeans, because man, they are really, I mean, they give you a headache just looking at the chart. They're everywhere. But just like corn, they've gone everywhere and nowhere in the month of July. That we are trading the exact same price point we were when July started. So when from this bar right here, right, which is the close on July 1, we're trading the exact same price point. So what does this mean? Well, obviously you've got the same sort of formations, right? You've got a big consolidation zone between 15 and 13. That's a giant $2 window. And the options are priced similarly. I mean, you know, it costs $1 to own at the money options. Sorry, 80 cents. So it costs 80 cents. So you've got a 14.80 and a 13.20 window if you buy a put or buy a call. So with soybeans, you've got the same amount of variability, right? But you have actually tighter stocks. And I know the Twitterverse is telling us that that the South American crop is going to be huge, and that you've got a wall of supply coming, and that's why we should be trading lower. I get that, but the market's known that all along, right? The market knows this stuff. It's not stupid, and so really you've got the same dynamic setting up in beans as you had in corn, which can be radically bullish. And so the market tends to catch the most people off guard at just the wrong time. And exactly what would that be today? Well, it would be catching people off guard to the bull side, because everybody is bearish. Every analyst is out there is bearish. So I think what we want to do is wait. I think we want to be patient. And my advice to you is to not check Twitter. Don't check forecasts. Don't check Twitter. Don't read any news. Just be patient. Let the market do its job. Let us figure out exactly what's going to happen, because we're going to get good signals that tell us what to do. But there's nothing in here that would suggest that we need to drop back to $10.50, $11 on beans. And at the, today, there's nothing that says we need to go to 18 either. So I think we're just going to chop sideways, and we don't want to take any action right away. If you have to take action, what I would recommend doing is selling cash and buying and managing your upside in your account. That would be a better choice to me than trying to do anything else. But I think the risk is up, not down for now. And I know I've been saying that for a month, but we've now gone all the way through pollination, and we didn't really break the market. We tried, but the buyers stepped in and just started buying it. So I don't think that we are quite as bearish as everybody else. Now, I will tell you that we like to follow lots of Elliott Wave analysts, and we have two primary analysts that we really like to follow. And I will tell you that they cannot be more diverged on their approach. We have one that is calling this a wave 4, and that we must go to new highs on every one of these markets. And we have one that thinks that this is a wave 1 down, and that this is a wave 2 up, and that we've got to turn around and go lower. So you can't get any further apart than those two, and one of them's wrong. I have no doubt about it. But I don't think it's. I think both of their both of them need more consolidation and more time in order to figure out what happens. So I think we're going to keep getting banged around, but I don't think we're really going to go anywhere for a few more weeks. So, and I would not recommend trying to capture all the little wiggles in here. I don't think that you need to do that, which is why I'm advocating for patience. Okay, now let's look at wheat. Wheat is doing the exact same thing, right? It's gone everywhere and nowhere in the month of July. Here is the close on July 1st. Here's the close July 1st, 9:13. Here's the close July 2nd, 8:59. And here we are, right? So we've consolidated. We're trying to beat out a bottom. We've got nice bullish divergences on wheat. If anything, wheat is setting itself up here to be the leader on a move higher. I have no idea what the catalyst would be for that. It could be the Ukraine situation. It could be the planting situation that we have here in the States. I don't know what will cause that, but this is what this is set up for, is a rally in Kansas City wheat. So I think that the best thing to do with wheat for next year is to be really patient. Just like corn and beans, these things do trade in relationships. So let's end talking about the relationships everything trades with, right? You look at the screens today and they're either all green or they're all red. Under normal trading conditions, corn and wheat are going to trade with a very high correlation, right? They're going to trade very similarly. So it doesn't make any sense to me that corn can be bearish and we're going to go drop a buck with these divergences on wheat. So I don't buy that analysis at all. I think wheat's banging out a bottom, and I think corn, if it breaks higher, has got to go with it. So I don't know what'll cause that. Who knows what the Twitterverse will find as a rationale behind it. But I do think that wheat's got to work itself higher in order to kind of satisfy some of these divergences. And then if we get back up into the $9.50, $10 range, we'll just have to see what it looks like when we get there, right? There's a lot of natural chart resistance here. You've got this peak at 10, and you've got this floor right down here at 10. So that could provide a little bit of resistance. And if you get through it, then who knows? But this is probably the area that we want to start taking some action in if we're able to rally back up to there. Okay, that's 17 minutes. Again, I cannot advise enough to clear your mind and get away from stalking the weather forecasts and reading every analyst that comes out with a different opinion. Because everybody's trying to justify every move that there is, and I'm just telling you, there is no justification for a 80-cent swing intraday on any of these crops. None of them are changing values that fast. There's no reason for it whatsoever, other than funds trying to trade very short term to improve their position, and that's why we're going everywhere but nowhere, and we're establishing these giant trading ranges. Okay, if you have questions or want to talk through anything, if you need to talk to us about risk and are uncomfortable with where you're at, please call us, let us know, and we'll try to get it in a position that is will help you sleep at night. Otherwise, the best medicine you can have is just get out and be active and don't pay attention to the squiggles, which I know most of you are really pretty good at. So maybe we're talking to ourselves more than some of you are, but on that. So I hope you guys have a great week. Call us, talk to us. Remember, there is clearly risk in trading all of this chaos, and we will talk to you next week. Have a great one.